Well, welcome everybody. I see that we have a nice crowd already here, so I want to thank everyone for being here. Welcome to Loan Vision's monthly webinar series focused on the bank and credit union space. My name is Brian Friedman. I'm the VP of Sales at Loan Vision. I'm going to be the moderator for today's session. Our topic is strategies to improve pricing and gain market share. And I'm excited to have a full squad from the MCT team for a fireside chat here. Now, a couple logistical things before we actually jump into it. This session is going to be recorded. Everyone is muted. We do want this to be interactive. So what you're going to see in Zoom is that there's a Q&A box that's available. If you click that, you can put any questions that you have into that box. We're going to do the best that we can over this session to pay attention and to try to address as many of those questions as possible. So with that, let me introduce you to the MCT team that's joining us. So we have Danielle Shipley. Danielle is MCT's VP and Regional Sales Director, responsible for overseeing MCT's West Coast territory, and is a key contributor in promoting process improvement and industry alliances. In 2021, Danielle was honored to be included in the list of elite women in mortgage banking. Bill Sheriffs is MCT's head of the MSR Services Division, responsible for overall management, oversight, and strategic planning. Bill brings extensive industry experience in capital markets, structured transactions, credit risk, mortgage insurance, and strategic planning. Azad Rafat is MCT's Senior Director of MSR, responsible for ensuring their clients are successful in achieving their goals. He has more than 30 years of experience in the mortgage industry, covering all aspects of MSR valuations, analytics, and risk management, spanning portfolios of all sizes. And last but not least, David Burris is MCT's Director of MSR Sales. David has over 30 years in the mortgage industry. David has played a key role in establishing MCT's MSR brokerage division and has extensive experience in subservicing, MSR sales, and acquisitions. Now, for those that are not familiar with Loan Vision is the leading mortgage accounting and loan level financial software, helping banks, credit unions, and IMBs cut loan costs, reduce risk, and gain actionable insights. When core banking solutions fall short, many turn to Excel for it. But Loan Vision will fill that gap by serving as a mortgage sub-ledger, enabling loan level reconciliations, profitability reporting by loan, branch, and loan officer. Plus, Loan Vision offers a mortgage-specific compensation module. For those that are not familiar with MCT, MCT is a national capitals market advisory and risk management firm that has been trusted for over 20 years by banks, credit unions, and independent mortgage companies, offering hedge advisory, MSR services, lender analytic tools, and outsourced lock desk services. MCT has created the largest loan sale exchange platform in the country. Today, MCT advises over 400 clients, including more than 110 banks and credit unions. So let's get to the content. Let's get to the good stuff. So the objective of the session is to talk about pricing sophistication, but we all know that a lot goes into that. Part of the equation includes MSR, mortgage servicing rights. So David, what exactly are mortgage servicing rights?
Obviously this has been in this business a long time, but I was trying to look at something that would make it as simple and straightforward as I could. Really, mortgage servicing rights is the contractual right to service a mortgage loan. And this opportunity arises when a mortgage lender sells a loan to an investor. The lender then has the choice to either keep the loan and service it or sell it away. And so if they retain the loan, then those are the mortgage servicing rights. And then their job is to maintain that loan with all the activities I think people might be familiar with. In other words, they do things like send out statements, collect payments, allocate principal and interest, manage the escrows, taxes, insurance, all those types of activities. And they do have to be approved by the investor in order to service their loans, which means that they also have to fulfill the requirements of the investor in the way they service the loan. So I'll stop there. I hope that helps. I don't know if anyone else wanted to add anything to that.
Yeah, I just wanted to add a couple of comments to that, David. Great explanation. I think I wanted to just reinforce that MSR is often sort of the forgotten element of pricing and execution. It's kind of pushed to the side, but it's a critical part of it. And mortgage servicers perform a critical function, all the functions that David just described. And the reason they're important is that the agencies are not equipped, not chartered to actually service. They can't, even if they wanted to. So the mortgage servicers are necessary, and they fill that necessary step that the agencies can't provide. And just to give a quick example, what typically will happen, the vast majority of our clients sell on a cash window basis. And what they'll do is they'll strip off a spread to cover the servicing. And it's typically 25 basis points. It can be different. So if you've got, for example, a 7% note rate, you would take 25 basis points off of that. And then the pass-through rate becomes 6 3/4. So that 25 basis points is used to compensate the servicer for all of the functions that David just described. So just to elaborate, it's a critical part of the execution equation.
That's perfect. Great. Anyone else have any other comments on that? No, we're good. So this is for Bill and Azad. Everyone involved in the mortgage space understands that overall production has been a challenge over the past couple of years, putting pressure on production revenue. But what about MSR? Are the challenges similar there?
Well, and that's one of the I think benefits of having an MSR portfolio, because it does behave differently from the production side of the business, and it is certainly a beneficial asset to have on the balance sheet. But despite the uncertainty and the volatility with overall mortgage production, and actually volatility around margins and profitability, the MSR asset has actually been a bright spot for asset holders over the past several years. Values for MSR portfolios have remained robust, and many would characterize them as strong. Interestingly, continue that anemic mortgage production levels. That is actually what's fueling demand for MSR. So entities, these large entities that are growing their servicing portfolio, because they are not producing the amount of loans that they would like to on the production side of the business, they are actually buying on a bulk basis. So that's driving demand for MSR and actually propping up prices for MSR. So levels have been very strong. Additionally, we are experiencing more servicers commit to retaining more of their production. David talked about releasing versus retaining. We're seeing more of them currently retaining, despite strong servicing release premiums in the marketplace. And that's really because of the runoff from principal reductions. So they're seeing their portfolio shrink, and in order to maintain a decent sized portfolio, they're retaining more to build the franchise value. And the last point I'll make is, although performance of servicing portfolios has been solid for a number of years, there's always underlying risks that servicers need to monitor. We're seeing delinquencies start to tick up a little bit. We're seeing consumer debt levels at record levels. So that might have an impact on performance over time. All of that requires oversight. And that's one of the functions that servicers perform as they manage their portfolio. And with that, I'll turn it over to Azad. I know he's got some additional color to share.
Definitely. Thank you, Bill. Since the pandemic, actually right after the pandemic, we saw an influx of refinancing. And if you look at the entire mortgage portfolio across the industry, it's somewhere around plus $12 trillion. Almost half of that has an interest rate below 5%. It created opportunity. At the same time, it handicapped the industry. So most of the borrowers who have 5% or lower interest rate are very reluctant to refinance their loans. That itself created another industry. We are seeing HELOC, second mortgages expand rapidly during the last 18 months to 2 years period. And then at the same time, we're seeing a lot of non-QM production that is expanding rapidly. I mean, if you look at through the entire year of 2024, the increases were about like 20 to 30% quarter over quarter to quarter over quarter. So the dynamics of the mortgage production has been changing. And there are a lot of other variables that are contributing to that. I mean, if you look at the consumer debt, that continues to rise, pushing the debt to income ratio closer to the mid 40s and in some cases close to 50%. So it's driving a lot of borrowers away from GSEs because of the underwriting requirements, and then also pushing their credit scores lower. So they're not able to get qualified for agency loans. So that's why we see more and more borrowers going into non-QM and second mortgage. Second mortgages like 2023, 2024, for instance, credit unions were averaging somewhere close to $50,000 per loan, but we're seeing more trending upward, close to 100,000. We're seeing some independents. I mean, I'll give you one example, like Rocket Mortgage. They're even offering up to $500,000 second mortgage loans. So the landscape is changing dramatically. So the borrowers have so many other options right now, and they have different choices to make their decisions based on that. At the same time, when you look at the originators, lenders, their profit margins continue to tighten quarter over quarter. So it's becoming very challenging. So it becomes necessary for those lenders to find alternatives. And such alternative is to have an MSR portfolio. As profit margins in decline on the origination side, the servicing portfolio provides critical cash flow to the business, hence, more liquidity, hence more enterprise value and such. And one of the things we're seeing trending right now, and actually over the last couple of years, we're seeing like origination prices, new production prices outpacing the fair value. And if you don't mind, Brian, if you could turn to the next page to the chart.
Yep.
This chart is a historical trend of service release premium versus fair value. The red line represent prices offered by the aggregators. The green line is the fair value over time for similar product. And the blue line is the Freddie Mac 30-year fixed rate over that period. And the yellow space is the spread between the fair value and the service release premium. If you look at the entire market, the SRP right now is a win-win situation. I mean, you just cannot compete with that. And the reason for that is the aggregators utilize repurchase capabilities. They could, I'm sorry, not repurchase, recapture capability. They could recapture, pay them full loans. They average roughly between 60 to 80% of any loans that pay off. They could recapture it easily. And they also use economies of scale to help them with providing better pricing, very competitive. On average, if you look at the last 2 years, we're averaging somewhere between 10 to 15 basis point spread between service release premium versus fair value. So that's why we saw in 2024, 2023, a lot of lenders were releasing the loans because it just too tempting not to take it. It's very competitive. We were looking at about 5.5 multiple level versus fair value, somewhere around 4.5 multiple, 5 multiple, depending on the product. But it became evident last year, especially for companies that have servicing portfolio, they saw their UPB decline, and not because of payoff, but because of principal amortization. So they realize their fee income on the servicing portfolio has been declining because of declining UPB. So they changed and shifted strategy. They started retaining, more loans than they have been during 2023. And I'll turn it to David over to kind of go over that, spread between retention and release to, more detail on that side.
And before you do that, David, really quick, I just want to remind, we have a lot of folks that are still coming in here. If you have questions, we encourage the questions to come in. Just use the Q&A box in chat. You can click it and ask anyway any questions that you have.
Yeah.
And Brian, do you actually have any questions? I think you had a few that you were going to ask along the way as well. That might be a good time for you to ask,
I do actually. Yeah. And it's perfect because I was going to come to David anyway. So, David, when you think with servicers, when they think about retaining or releasing, are there specific market trends that they should be monitoring? And if so, how frequently do those levels change?
Yeah, no, thank you, Brian. Appreciate that. Thank you, Azad. Brian, I do think you have a slide to pull up for me here to kind of go
Yep.
through this as well. So if we can pull that up. Interestingly enough, MSR values are very active, and SRP values in the marketplace are very active. And we actually track that execution among all of our clients. And we track it on a weekly basis. And I've just getting older, so I recently had my heart test, and I got this kind of looks like what my heart test looked like. So it's actually very it adjusts a whole lot more than you think, and so it's really a number to keep track of for a lot of reasons. Bill alluded earlier to the issue around MSR and pricing, and that's something I'm sure we'll talk a little bit more about as well. But it's a volatile scenario that exists out in the market today, and right now the market has averaged going from an execution of 60% released to 80% released kind of on a weekly basis, and it can really, as you can see here, it really kind of pops around on a weekly basis. And there's a lot of factors that drive that, and I think the main thing is, first of all, be aware that it's not static, because in many cases people think it's just a flat number that just hangs out there, and that's the way that it is, but it moves around all the time and creates a lot of opportunity. So the other part that comes into the idea of if to retain or release really becomes to the strategy of the organization. Because as Azad was pointing out, in general, the execution is the investors are paying up so much for the SRP, dollar for dollar, the cash execution by the investors is going to win every time. However, when you start to look at the franchise value of retaining loans and building your own portfolio, there are a lot of other values that come into place, particularly for community banks and credit unions, where membership is important, where the account holder is very important, and there are more different values to sell to one client than just a mortgage. So, and what we do is we help folks kind of identify those values and then start to include that into their execution. Yeah, Brian. And then the other thing is really around the value of the portfolio itself. Just to reemphasize what Azad said, these loans that have been on the books for so long, their cash flows have been incredibly helpful for people to keep their cash in place. However, over time, those cash flows are starting to decline by and large, because of the declining balances. So if you want to continue to increase the value of your portfolio, it's essential that you look at new loans to add to that portfolio. So I'll stop there for now and see if there are any questions.
Yep, I appreciate that. Anyone have any comments on this slide or anything that David said?
I just wanted to elaborate and emphasize the point that David made around, you can see the chart, it shows volatility. So what that's telling you is that the pricing isn't constant. And anytime you want to maximize execution, you got to be nimble. You've got to watch the market. You've got to evaluate all of your alternatives, whether it's to sell to a number of different investors, whether it's comparing the Fannie pricing to the Freddie pricing, retained versus release. That's what execution is all about, because the market is moving every day. And this illustrates that it includes servicing as well. SRP levels are not static. They're not flat. They're going to move based on the aggregator's level of demand that week or that day. So as we talk about execution, always emphasize the importance of including the MSR component in that analysis in your process. So just wanted to kind of emphasize that point.
Appreciate that. That's great. Danielle, historically, it's been very common for mortgage originators to assign a flat or static value for their MSR. Does that create challenges? And if so, like what are they that they have to deal with?
I love this question, Brian, and thank you for raising it, because we see the same thing that you guys are seeing. Oftentimes when banks and credit unions come to us, one of the major reasons is because they're trying to figure out, how can we get more market share? We're having issues competing, and they shouldn't have issues competing, right? Because when they're competing against another originator down the street, they have more net worth than them, they have more options, more capacity, and yet they just can't seem to get their pricing in a competitive range, right? And so they're looking to us to say, how can we earn more market share? And what we oftentimes find is when we look at their street pricing, what pricing are they passing along to their member or borrower, and how is that built? How is it constructed? And so part of that pricing is going to be constructed using their value of what their opinion of value is on their MSR, on their mortgage servicing rights. What is that value? And oftentimes they'll use just a static, or we would say flat value, better said. And that flat value, it would be the same for all loans. And it's a lot more common than you would think. And it's nothing, to be shamed about, because like I said, oftentimes they've just always done what they've always done. And it's worked for them. But in such a competitive times that we're in, really getting as precise as you can does make a difference. And using that flat value for all loans just poses hidden challenges, where they're thinking, okay, we're passing through our agency price, we're getting as thin as we can on margin, and we still can't compete.
Makes sense. Anyone have any other comments on that?
Yeah, Danielle, just to tag on to that, I think one of the things is that people don't realize is that the performance for loans, the pricing in the market today really gets to be granular and loan level. So if you're pricing on a macro basis and not a micro basis, you're automatically losing. Danielle's explaining kind of really how you're going to get more of the loans you don't want, because you're going to be overpaying for those. And then you're going to get less of the loans that you do want because you're underpaying. And really the only way to get to that is at a granular level, where you look at the characteristics of the loan and you start to understand from a prepayment standpoint. That's another way to look at MSR value, is think about prepayment. Which one is going to stay on the books longer? Which one of those loans is more valuable than the other? And one is not like the other. So, and I think that's what we're trying to point out.
Yep. That's great. Danielle, so thinking about a specific example of a single loan, how does that math work out? And on top of that, how might the approach impact the price to the borrower or member?
Okay, it's a good point. And so just getting a little bit more specific, let's just throw out a random value. So let's say that bank or credit union is going to be able to sell the loan to, let's say, Fannie Mae. Fannie Mae is going to pay 102. And let's say that the credit union or bank has long ago decided that the value of that servicing to them is 100 basis points. We've seen it at flat 50 basis points. We've seen 75. Okay, but just they have a flat value for every single loan. So you would take that 102 price that you're going to receive from Fannie or Freddie, let's say, and then you would add that 100 basis points of value, and they would back out whatever margin they would need to cover their costs and so forth and their needs, and then that end of that equation then becomes the price that's passed on to their borrower or member. So it is directly passing through to their street pricing, and so it is a huge impact. And like David was saying, the value of the MSR, it changes based off of, we know that loans perform differently in different states. We know that different FICO scores perform differently. We know that loan to value performs differently, right? And sometimes when we're thinking about, like David was talking about, prepayment speeds. So when we're looking at prepayment speeds, we're looking at it from the lens of how long is this loan going to stay in our portfolio, and loans that are going to stay in our portfolio longer are worth more. Loans that are going to prepay faster or have the propensity to prepay faster aren't worth as much from an MSR perspective. And so sometimes we think the highest FICO score borrower has, the highest value from the MSR side. And that's where we can help, to get a little bit more granular in the way that we're looking at MSR values, because that high FICO score borrower with a very low loan to value, we're thinking, hey, that's a guy I would want to personally lend to if I was lending my own money. But if I'm a bank or credit union, that loan is going to have a propensity to prepay because that borrower has a lot of options. So we're thinking about, the likelihood of that loan to pay off when we're looking at those adjustments. And, from our perspective, we're looking at those adjustments from, there's hundreds of different ways that we can look at that MSR value and then get more granular, so that when we add that pricing to it, as David was saying, you have the right loans with, priced correctly. So 100 basis points might be over or underpriced. And it could be dramatically underpriced. That loan could be worth 150 basis points, 130 basis points. It could be worth 75 basis points, right? But each loan has its own individual value. And that is something that can be passed off to the street, your member or borrower, when I, refer to that, which can help you, better compete and get more loans and get more loans. We have a question coming in. Okay, let's see, what was the question? Forrest, okay, so the question here is from our friend Forrest. What is the difference between using the MSR value that an institution uses to set their day one rate sheet versus the MSR value at the point of decisioning in the best execution and loan sale when determining the retained release strategy? So this is a great point. And I think what we see too is it's a good idea. So at MCT, we have our MSR services division. There's a lot of great providers out there in this space as well. But we would say on our side, when you're setting your, let's call it street pricing or your member or borrower pricing, and then you're doing your retained release decisioning, and ultimately then you're valuing your portfolio, those can be different values, but you want to be using the same model and the same logic behind that model to create those values so that there's cohesiveness, right? So sometimes we'll have banks or credit unions that'll come on that want MCT to do their valuations, but they're still using maybe, a limited view of their MSR, and that, that can cause a disconnect in the way that their portfolio performs and the way that their pricing is issued. So to go back to your question, if we're looking at the day one rate sheet pricing, we do have a rate sheet product and pricing division where MCT has decided that this is so important. We've actually dedicated an entire division to it with its own staff, and that's really all they do is focus on helping clients to put forward upfront pricing and analyze that. So at MCT, we would provide clients with a fair market value grid that they could then use if they want to. If they used another provider, they could, we could pull in that grid. So the MSR value that's used at the point of that we're using to price the loan should be the same grid that we're using then to run a best execution on the loan. Now that would be different than from how the loan would ultimately be valued in a portfolio, because there's other criterias and other views that we're looking at when considering that loan that has been on the books a little bit longer in consideration of market movement. And maybe Azad or Bill or David, would want to comment further on Forrest's question here.
Yes, definitely. Thank you, Danielle. The way we look at it, I mean, just like in the earlier chart that I was showing comparison between the service release premium street pricing versus fair value. Uh, Today and has been for the last couple of years, those market prices have been very aggressive, very competitive for a reason. So, and that's why we saw a lot of companies release the loans to the aggregator because it was better priced for immediate cash gain. However, if you decide to retain the loan, you really, in our opinion at least, you shouldn't capitalize the loan at those SRP levels because they're very aggressive to begin with. And because of the nature of the price is very aggressive, that price is going to become very volatile and very sensitive to the slightest rate changes in the market. So you don't want that on your balance sheet. So that's why we always recommend to utilize the retained fair value price, which is about roughly on average about half a multiple lower than that street price.
Yeah,
Excellent.
I would just add that, every entity has a production strategy. Every entity has their own execution strategy, right? So we're equipped to support whatever your strategy is. The vast majority of our clients use our fair value grids, which we produce on a weekly basis to help inform their rate sheets. So that's the starting point. But we also have some clients that say, look, I want to be more aggressive. I want to win more business. So fair value may not get them there. They're looking at themselves versus the aggregators, and they're saying, I want to compete against those levels. Well, how do you do that? Well, you've got to create custom levels that make you more competitive. But that's based on your strategy. That's based on your objectives, which we can support. But the starting point, in our opinion, is always fair value, and then you build from there.
And just to add to that real briefly, I think there are two things, Forrest, you're pointing out here. One is how do you price to acquire the loan, and then how should you value when you start to put the loan on your books? And I think that's what we've been trying to speak to in different ways. The pricing always needs to account for your strategy. And the way you value at time of best X and loan sale really is best done when you can get a live MSR value, because pricing and the actual value, MSR value of the loan, can be two different things. So if there's a way to get a live MSR value at the time that you make that loan sale decision, and that's how you can get the best view of what that loan on an MSR side is actually worth.
Makes sense. Makes sense. Azad, I'm coming to you for this. Many understand that there are several factors that impact the loan's value, cash flows, and performance. But are the loan level differences enough to warrant that level of scrutiny?
Absolutely. When you have aggregators, a lot of times, and we review those aggregator pricing on a regular basis, we see those values shift from one, criteria to the next every, 2 weeks or every 3 weeks or so. If you don't mind, if you go to that grid chart that I have.
Yep. I'll pull it up.
So this is a standard fair value grid that we produce on a regular basis. So you could see, and Danielle touched on that, each loan, different interest rate, different principal balance will have different value. And most likely what's impacting it is obviously the prepayment speed, the prepayment forecasted speed. All that will determine how fast, how slow will prepay. The LTV, the FICO, the balance itself. I mean, when you look back, even though during the pandemic, it was one of those one in a lifetime situation, black swan event. If you look at the underlying prepayment that took place right after the pandemic and when the refinancing picked up, the very first group of loans that came out as a refinance were the high balance loans, even though they had 5% WAC, 4.5% WAC. But the majority of the loans that started out the refinance trend were the high balance loan. And then, trickled down And lastly came in, the loans with 200,000, 150,000. So historically, even you go back to the earlier years, back in 2013, 2014, anytime there is a refinance opportunity, the first one go out of the door is basically the borrowers with high balance. So what does that tell us? It tells us that low balance loans will perform better. And we see the aggregator pricing align that way. We see them focus on high FICO, low LTV, high balance, because they tend to be defined as high quality loans, which is true. But then when you compare the duration on your balance sheet, they have a very short life on the balance sheet. The ones that have longer life on the balance sheet are the ones with the high LTV, moderate, FICO score, somewhere around 680, even though there is a risk of delinquency, but they tend to stay on the books longer. So you could, based on the decisioning strategy, you can compete with the aggregators. Say, okay, I'm going to release the high balance, high FICO, low LTV, and retain the ones with moderate LTV, moderate FICO, moderate balances. And even though they may have lower value, but then they're going to stay on the book and they have long-term rewards down the line.
Excellent.
And one more thing, I apologize. One more thing, geography obviously has its own impact depending on the economic condition, home prices, all those factors will drive geographical prepayment influence.
That's great.
And I just wanted to say, Azad, and you said that so beautifully. I just want to say too, just even looking at this fair value grid, I know for me, when I came to MCT, I came from the origination side. I had branches, and I was intimately involved in my own pricing strategy prior to coming here. And then we weren't very sophisticated in the way we were looking, honestly, at that MSR value. And then looking at this fair value grid, I mean, you can see this is just one view of it, but there are many tabs and there are many other adjusters that we're not seeing. And so it just really blew my mind to think, wow, look at how different these values are. I mean, you can look at this just in this limited view we're looking at. We have, 0.543 for the 6.75 note rate, ranging all the way up to over 100 basis points. But there would be other adjustments that would be made, as Azad was alluding to. So if you were looking at our grid, there would be multiple tabs on there that would also play into that loan level value. So it's pretty amazing to see. And usually, and maybe some of you are having that aha moment on the call right now, and you're going, wait, we're using a flat value, or maybe we're only using a couple different adjusters, and it's not varying by state and by FICO and all these other ways that it can be adjusted. And that really is a key driver, and that will improve your pricing. And you may even find that you're going to be happier with your portfolio makeup, because it'll be driven by your execution, then is driven by your overall strategy.
Perfect. Thank you for that commentary, Al. This is for the whole group. So besides considering the flat MSR values, are there other factors that cause challenges for banks and credit unions to have difficulty competing on price?
Okay, I'd like to take this one just to start, if you don't mind, because this is near and dear to my heart. Because let's say we get the upfront pricing dialed in, right? So we're comfortable with our street pricing. We have a loan level MSR value that matches our strategy, and it's thoughtfully included. And then we still are sitting in a situation where our bank and credit union clients looking around going, how can we not compete? Why are we not competitive, right? And so there's this other piece of it, which has to do with a new trend that we're seeing. And that is that some of the originators that they're competing with, they can be nimble, like Bill was talking about earlier. He alluded to this, where they can actually release their loans. They don't, they're not required to hold servicing on all loans. And maybe it's a larger investor or originator that can pick and choose which loans they choose to retain or release. And so that in that situation, that's the best case situation that an originator can be in. From a bank and credit union perspective, it's always been the school of thought has always been, we want to hold servicing and care for our members or borrowers. We do not want, and we will not consider releasing servicing, because we want to own that member relationship. But what we find is you can only own that member relationship if you actually get the loan, right? If they're not coming because you can't compete on price and you're not getting those loans, then you don't have the at bat, shall we say, with that borrower or member. And so considering just considering a more diversified view of your execution strategy at the time that the loan closes for that loan sale piece is really huge. And we find that the banks and credit unions that become a little bit more open-minded, which again is becoming a trend that we're all seeing, on this call, in the market, that are a little more open-minded on maybe just, not releasing, we're not saying release, half of your volume, or even a quarter. It could just be a very small amount that you consider releasing to an aggregator, which could look like you sell the loan to Fannie or Freddie and you sell the loan to a co-issue buyer, or you sell both the loan and the servicing to an aggregator released. We can help to identify aggregators that don't have aggressive recapture programs, so that borrower or member still becomes your client. And really, when they have good pricing that they get, and even if that loan is sold, they come back to check with you again. And there's other ways that you can market and sell them other products. So we find that it just at least gives them the ability to capture that premium pricing in the market, which they can then pass through. Because a lot of these originators, when we say, oh, this pricing looks nonsensical, it's because they're overvaluing their opinion of servicing. When we're marking loans to the market, right? We mark to market our loans. But when we're marking servicing, the difference is we're marking to a model. And that's a theoretical model. So as long as you can prove that your logic is, it makes sense, you can have a range of what those opinions of MSR values are that are both going into your street pricing and also going into the thought behind your portfolio valuation. So there's some wiggle room there. And some originators just feel that they're better at recapture than others. So they're better at recapturing and reducing those prepayments in their portfolio. So they'll pay more, for servicing, which can also impact that. But certainly being able to capture that premium pricing to the market that is readily available to every credit union and bank, and considering a diversified strategy is huge, because they can take that additional revenue and pass it off through better pricing to their members. And then they get more members or borrowers. And for the small number of them that are released, they can still have that opportunity and have that at bat to consider other products and ways to engage. Yeah.
Just a few things to add to that. I mean, it certainly makes sense to be nimble enough to take advantage of market opportunities. That's exactly what you just outlined, Danielle. But as we know, there are a lot of banks and credit unions that are very committed to retaining. And there are reasons for that. And what we would recommend is that you think about why, and you build some of those whys into your street rate pricing, right?
That's right.
The whys could include cross-sell opportunities, which means the value of the relationship with your borrower or your member. Is that a value beyond fair value? You should think about building something into your street pricing to recognize that. Are there operational benefits to selling directly to the GSEs that you don't have selling to an aggregator? Build that into your pricing. Are you looking to build the franchise value? If you are, if that's important to you, think about how that should impact the upfront pricing. And then lastly, do you care about the financial stability that the MSR asset brings and the cash flow reliability? All of those things can be factored into the execution, which a lot of entities don't do that. They'll just apply that 4-to-1 multiple, and apply a 1% value. But if you really think about why you're keeping, I'm confident, get to a level where you're probably actually building in more value into the MSR because of those other elements that I just outlined. So just a few things to think about.
Yeah, when we have
Right.
clients that are just starting out with a GSE relationship and are starting to look at building their portfolio, what Bill described is the common steps that we walk through with them. What we found that they haven't done is really built out their own internal strategy around why they're retaining. I mean, they know it's good to retain. They know they like their members to retain. They want to take good care of their members, but they really haven't put kind of the dollars and cents part of it together. So in most cases, they're kind of wandering in the dark a little bit. And the other big factor that has been alluded to, but I think it would be worth highlighting a little more, is the large aggregator and their ability to put a tremendous SRP price in the market. And because we get this question all the time, how can so and so put that price out there? It just doesn't make any sense. And there are factors for large aggregators that just don't come into play for anybody else. And what they have done is put a dollar value on those. So there's, obviously there's a runoff that occurs every year on a portfolio. When you've got $100 billion portfolio and you lose $10 billion, you need to replace that as quickly and as fast as you can, because if not, your costs are going up. And for a large servicer, that's a huge ordeal. And so that factor alone can drive people to put pricing on in a really high value in their price. And then the second thing is what Danielle pointed out, which is people that specialize on refinance. We've talked to a number of large services that build in 2 to 3 refinances into their pricing value for the life of the loan. So those are just a couple of the reasons that give the large aggregator a leg up and kind of in terms of what they can price out there and make a price that they put not make sense to anybody else, because when you look at your own numbers, they're just not even close.
Right. And then we'll also see, community banks and credit unions, or major banks that they get into such a great rhythm with, Freddie. Freddie's a great partner to have. Fannie's a great partner to have. They get into such a great rhythm with one of those agencies that they feel content, right? And so they stop there. But we would say, even if you wanted to retain servicing on everything that you had, you ought to be considering making sure you have both Fannie and Freddie, right? You ought to be considering thinking about being able to take advantage of your FHLB relationships, which a lot of banks and credit unions maybe don't think about, where you can still retain that servicing. And then you have pricing opportunities, particularly through the FHLB, that your other originators, those independent mortgage bankers down the street, they can't take advantage of that relationship, right? So there's certainly advantages to having the position of a bank or credit union. And what we're saying is just maximize those advantages, right? Get approved with those top aggregators that you can, and take just a portion of your portfolio and maximize that so that you can pass on that pricing on the remainder. Yeah, Azad, I think you had a comment.
Yes, what I wanted to say, I mean, I've been in this business for a long time, and one thing that really excites me about the mortgage industry is no matter what the circumstances in the industry are, there are always some opportunity somewhere. And what we're seeing right now is something really we've never seen before. There's a large disconnect in the market. Typically, as loans season, the prices decline. But right now, we're seeing loans from 2020 through 2022 production have values even better than current production. So that's one thing hasn't existed before. So it creates this opportunity, this revenue potential. And even with the current high interest rate environment, we're seeing more demand for loans that outpace supply. And that pushes the aggregator to offer those very competitive pricing, very tempting pricing to service release the loan. Even though if you want to retain something, you need to devise a strategy internally to determine, okay, if I produce all these loans, the aggregator is going to beat me anytime, any day. But you could devise an internal strategy to, say, okay, these are the type of customers I want to retain and keep on my books, regardless of what I'm being offered out there. So there are so many ways you can compete and be very dynamic in this market.
That's great. That's great feedback. Bill, is something you want to add to that, or?
Yeah, I actually, I'm thinking about the CFOs on the line. And one thing I just wanted to emphasize, the MSR is not an all or nothing proposition. You can retain some, you can release some, you can retain for a while, and you can liquidate after a while. I mean, the MSR and the agencies work very hard to make certain that MSR is a relatively liquid asset. It's certainly not cash, but it trades hands pretty quickly and very efficiently. I mean, back when I was doing it, similar to Azad, I mean, it took 6-9 months to get approval to transfer a portfolio. Now you're seeing approvals inside 30 days. And they want that liquidity because it's good for the GSEs to maintain liquidity in that space so that they have other servicers that are available to service their loans. So anyway, it's not an all or nothing proposition. It very allows you a lot of flexibility around cash flows. And if the company needs to liquidate at some point, the market's equipped to support that. So just a few points.
Yeah, Bill, that's a great point in terms of, and I think that's something maybe to bring up about MSR when you're managing your portfolio is you can when you look at your portfolio, you can look at the types of loans and characteristics of loans that you want to keep. And if you find that you have you're starting to grow a portion of the loans that really doesn't fit what you're trying to build, then that's certainly something that is saleable and liquidable and easy to put out into the market and move on. And that can be a very efficient move for an organization to really kind of help shore up their servicing and the way that they spend their time on the servicing side. So that's a great point.
Excellent. Thanks for the commentary from everyone. With just a few minutes that we have left here, and the final question from me, I'm curious if there's ever a time that it could make sense for a bank or credit union to sell any part of their servicing portfolio after the servicing has been held for some time.
Yeah, I think I was kind of touching on part of that by mistake, so I apologize for jumping into that question early. But certainly, there's always a market opportunity to looking at the market, depending on where the market's going with values. Then you can certainly look at whether it's worth selling or not. We certainly help our clients with that. There are a number of factors that relate to that, and I think we've touched on those for different reasons today. But we're in a very unique period in that there is very low originations occurring in the marketplace. You have lots of people that have capacity that they'd like to fill, and so you have lots of buyers chasing a handful of loans. So typical economics, you've got it's a seller's market. Loans on the market are rare, and so people are paying up for them. So it gives you an example of when it's a good market to sell. So there's always as I was pointing out, there's always opportunistic opportunities that come to play, and certainly right now selling could be, if it fits in with your other strategies, could be a positive thing to do.
Excellent. Any other commentary from anyone on that? Nope, we're good. Bill, Danielle, Azad, David, any questions that you see out there that we haven't addressed yet?
Well, and I've done this a couple of times during the session, but just to reinforce a couple of points. I mean, execution is all about flexibility. It's all about optionality. And, we often encourage our clients that if they're approved to sell loans to the GSEs but not service, go ahead and get your servicing approval, whether you intend to retain or not. It's just it's a good business practice to have that flexibility. So being nimble around retaining, releasing, selling on a bulk basis, all of those things, and based on everything that we've talked about today, it's all about having that flexibility and being nimble enough to take advantage of opportunities in the market, because the market moves every day, every week. And if you want to really sharpen your pencil and take advantage of execution opportunities, you've got to be nimble enough to adjust to whatever those opportunities are. So anyway, just wanted to emphasize that point. We're here to help, and if anybody has questions after this session, we're available to support whatever your needs are. So anyway, just wanted to make that point, Brian.
Awesome. Thank you so much. Any last commentary from anyone here?
Just one thing related to accounting. I mean, one of the things we constantly come across, different companies use different accounting method, either the fair value method or the low com method. And because of that, if you choose to go aggressive on the pricing side to retain the loan, it creates some challenges to manage that asset thereafter. And of course, depends on the accounting method. If you choose a lower conservative, pricing, also creates some challenges and opportunities depending on the accounting method that you utilize. But using a fair value, moderate value, it's just a more of a balanced approach that covers both types of accounting approaches, fair value accounting or low com accounting.
Awesome. Well, listen, thank you so much. I mean, there was so much information that was given out on this session here. So Danielle, Bill, Azad, David, thank you so much. I think everyone that's on this call got a tremendous amount of value from this. For those that are here or watching the recording, definitely join us for our next session, which is going to be on Thursday, April 17th at 1 p.m. We're going to be joined by the accounting firm CWDL. And also, please, once you close out of this, a survey is going to pop up. We always ask for any and all feedback that you have so we could try to make these sessions better. And keep an eye out. We're going to send out the recording of this session. It'll get to you, whether it's today or tomorrow, most likely. But again, thank you everyone for being here. Thanks to all the panelists, and thank you to MCT for joining us. Have a great day.
Thank you so much.
It's an honor.
Thank you.
Yeah,
Bye-bye.
we appreciate the opportunity, Brian.
You
Thank
got
you
it.
for
Thank you.
facilitating, and appreciate you pulling us in. And we appreciate the opportunity, and thank you to the Loan Vision team.
You got it.
Thank you.
Bye, everybody.